from the queue. The chair now recognizes the gentleman from Texas, Mr. Green.
Thank you, Mr. Chairman. I thank the ranking member as well. And Ms. Yellen, I thank you for appearing today. I'm looking at currently an article from the Washington Post dated May 17th, 2017. It's styled, "The nation's biggest banks have a common gripe. They have too much money." I'd just like to read some of the relevant portions. Banks are sitting on a $131 billion in excess capital, according to March research report by Goldman Sachs. If capital requirements are lowered, banks can return the money to shareholders in the form of dividends, boosting the payouts perhaps by 45% in 2018. This is according to the Goldman Sachs report. Hampering the industry's arguments has been record profits. Despite higher capital requirements, the country's banking industry reported more than $171 billion in profit last year, and the volume of bank loans has increased significantly since the financial crisis. So the question I have, Madam Chair, is this: should we change the capital requirements simply because we can have the opportunity to return more dividends, boost more payouts? Is that a good reason to change capital requirements?
I strongly believe that we should have strong capital requirements for the safety and soundness of the banking system, the financial sector more broadly. I'm comfortable with the level of risk-based capital requirements that are in place at this point, and especially the most systemic firms should have the largest capital buffers. So once those capital buffers are in place, the Federal Reserve has no objection to firms distributing profits as dividends to shareholders or in the form of share repurchases. This year in our stress tests, we approved the plans of almost all of the firms involved to return capital of their shareholders, but that's because we're comfortable that they've built the capital buffers that are necessary for a safe and sound banking system, and comfortable that they can go on even under severe stress, meeting the credit needs of the U.S. economy.
Thank you. Let me move to another topic because this is quite important and I don't want to neglect it. Thank you for your response to the letter that I and some 36 colleagues sent you concerning the African Americans, Latinos, and the fact that the unemployment rate for African Americans and Latinos always seems to lag behind Anglos. I'm mentioning this to you now because in your letter you do cite some things that may be beneficial in terms of some studies that will take place. But I do want to call one thing to your attention, and it has to do with something that these studies probably won't address. And it's just the issue of race itself. Just race itself. Plain old invidious discrimination. We have a difficult time legitimizing invidious discrimination as a cause for unemployment being higher among certain groups. We know that it exists, but we can't get the actual empirical evidence to legitimize the existence. Can the Fed, aside from these additional things that you'll be doing, and I salute you and applaud you for doing them, but can the Fed endeavor to engage in some sort of process that will allow us to acquire this empirical evidence? Because until we can present that, we still have persons who are in denial. Your response, please.
So it is certainly something that we can try to get at, although perhaps not definitively in studies that we do. There are studies that I'm aware of, experimental type studies that do pretty clearly document what you're talking about, that economists have produced.
One quick, if I may just ask this, could we explore the possibility of allowing testing to take place within banks? That's something that we have difficulty acquiring, testing empirical evidence.
I need to look into that. I'm not.
Time of the gentleman has expired. The chair now recognizes